The US Fed's own belief is that in order to bring inflation down to acceptable levels, they need to trigger a recession.
There is a big disconnect between what's happened in the equity market and what the debt markets are telling us.
The money that we see in the economy is not just the money that the central bank prints. This is narrow money. What we see is broad money.
This year, first half US fiscal deficit was $1 trillion. So annualized is $2 trillion, which is double of last year.
Hi, welcome to Open Dialogue by Axis Bank. Open Dialogue is a forum where we bring experts to talk about topics related to global macroeconomics, finance and banking, and to demystify these topics. In every session, we will take one topic and do a nuanced discussion around the various elements of that topic. I am Shetty and I am your host for these sessions. I will be assisted by two stalwarts in this effort. Joining me are Neelkanth Mishra. Neelkanth Mishra needs no introduction. Neelkanth is the Chief Economist at Axis Bank, and he is also part of the Prime Minister's Economic Advisory Council, and he's been an advisor to many government committees on these topics. I also have joining me today Ashish Gupta. Ashish is the Chief Investment Officer at Axis Mutual Fund. He has almost 30 years of experience in tracking Indian capital markets. He's an expert in global and Indian capital markets. He was till recently part of the SIDBI board and also is involved in a number of philanthropic activities outside of his day job. Welcome Ashish and Neelkanth, and thanks for joining us today.
Thanks.
So today's topic is about most expected recession in the history of the world, and is it imminent or is there a surprise in store for us? So we will start with a little bit of a macro perspective. Neelkanth, starting with you first. If you can just talk about where the world economy is, and why is there so much expectation of a recession today?
See, post-COVID, the central banks and governments across the world started innovating with policy making. For the first time in many, many years, fiscal discipline was thrown to the winds. A lot of cash was distributed. And that led to a very sharp and strong revival in many of the developed markets. But it also brought about a lot of inflation. Now, inflation can be very destabilizing. So the policy priority right now is for inflation to be brought down. The big debate is, can that be done without causing a recession? The US Fed's own belief is that in order to bring inflation down to acceptable levels, they need to trigger a recession. So they have been raising interest rates quite dramatically. So have other developed market central banks. And whenever this happens in the past, we've seen a recession. So which is why the moment the rates started going up, everyone started expecting a recession. The question is, why hasn't it happened so far? And I think there are two important factors. The first is that there is a fiscal monetary balance. Right? So you can manage economic cycles through fiscal routes or monetary routes. Basically, you can raise or reduce the interest rates, or you can have the government spending more or less. Now, after the 2008-9 financial crisis, the developed world had adopted a tight fiscal stance. So they were trying to bring down fiscal deficits very rapidly, and they were cutting interest rates very sharply. Right? So it was easy monetary, tight fiscal. This time, even as interest rates are being hiked up, they are actually keeping the fiscal deficit at a very high level. So this is an easy fiscal stance. This, I think, the markets had not anticipated, and which is why you are seeing that the pace of decline in the economic activity is not as fast as was expected. The second factor is that interest rates impact economies with a lag. So there are mortgages which are 3-year fixed or 5-year fixed rate. There are companies that have taken 3-year loans in 2020 and 21. And those loans, as they come up for rollover, is when I think the cost or the impact of these interest rates will start showing up. So I think it was a bit premature for the markets and the world in general to anticipate a recession, but I don't think we can rule it out.
Great, thanks. Ashish, coming to you, like extending the same question to markets. So
Sure.
one is obviously what's happening to the economy.
Yes.
But if you look at the markets, there was this meme that I read which said bears have accurately predicted the last 10 of the last 2 bear markets, right? So what's happening there? Like what's holding the markets and what's the situation there globally?
Sure. And I guess you are referring to the US markets in particular, right?
Yep.
And if you look at US markets, I think you're absolutely right. There has been a very large rally in the past few months. If you look at the S&P 500, it's up 10% just in the last 3 months. From October lows, it's probably up about 30%. NASDAQ is up about 25% in the last 3 months. But what is very interesting about this equity market rally is that it is very, very narrow, right? And in fact, it is narrower than even what we saw in the 2010 bubble.
Sorry, when you say narrow, what exactly do you mean?
Yeah, so I mean that very few stocks are driving this rally.
Right.
So S&P 500, the rally I spoke about, out of 500 stocks in that index, virtually all of the move can be explained by move in just 31 stocks.
Right.
Right. So it's not that there has been a revision in outlook of all the 500 constituent or the majority of the constituents. Right. If you look at the 5 main stocks, which is the famed Facebook, Apple, Amazon, your Google, right, Microsoft. These have contributed half of the rally, right? And this is probably coming out of the optimism on back of the transformation AI will cause in economies as well as these companies, right? So some of the key beneficiary companies like Nvidia is now trading at 40 times sales. Another interesting aspect of this US market rally is it is entirely driven by P multiple expansion. So it is not that earnings have been revised upwards. So I don't think the outlook on corporate earnings has changed as much, except for maybe a few sectors like energy, because oil prices have gone up or energy prices have gone up. But broad market earnings have not actually been revised upwards. But all that has happened in the last 3 months is multiples have gone up. Right. What is very interesting is that if we look at the other big market, which is the bond market, right, it is still distinctly saying and signaling a recession.
Right.
So there is a big disconnect between what's happened in the equity market and what the debt markets are telling us. And if you see the US bond market, the yield curve is still steeply inverted, right? The 2-year bond is at 4.9%, the 10-year bond is about 4.2%, right? So there's a deep inversion, and this inversion has historically been both a signal of recession, and many economists believe that the yield curve itself, inversion drives a recession, right? Because what do banks do? They borrow short and lend long, right? So if the yield curve is inverted, that means credit conditions will tighten.
So Ashish, I have 2 follow-on questions. First is this PE expansion.
Yes.
You typically expect when monetary conditions are loose, because then people are happy to pay more for future earnings.
Yes.
Here it's happening in a contradictory environment where the monetary conditions are quite tight, interest rates are really high, and the PE is expanding. So will be helpful kind of just to get you a little bit of perspective there. Second is this yield curve itself. You can explain for us a little bit simplistically, like what does this inversion mean, and why is inversion so strongly correlated to a recession?
Okay, sure. So if I take the second question first. So typically if you give someone money, right, you expect that the more the time you're giving the money for, he'll ask for the higher interest rate, right? Inversion of the yield curve means that money for shorter duration that is being given out is costing higher than the money that is being given out for the longer period of time.
Yes.
This only happens when you believe that in future the interest rate will be lower than what it is today.
Right.
Right. And that's why it is used as a signal for recession. That means that market expects that while interest rates are high today, they are 5.5%.
Right.
But in future, the central bank will cut rates because a recession is coming or growth will be lower.
Right.
So they will cut rates to stimulate. So that is why someone wants to lock in 3-year rates even at a level which is lower than what the current rates are. Right. The other aspect of this is if the yield curve is inverted, what I mentioned, it is probably a cause, right? Because typically all lending institutions borrow at the short term, right? Because they are taking deposits and then they lend it for the longer term. So if it is costing more to them to borrow compared to the yield they will get when they lend, then they will be more reluctant to give out credit. Right? As they are more reluctant to give out credit, that itself will cause a slowdown in the economy. And sorry, going back to your first question.
The PE expansion versus the macroeconomic monetary conditions. Right?
Yes, so I think you are absolutely right that typically it happens when interest rates are lower and monetary conditions are tight. In this case, as I mentioned, it has been very narrowly driven because everyone has now looked at only a few companies as the key beneficiary of this potential AI revolution. Right. So all the money is getting concentrated into those few names. That's why, as I mentioned, the rally is very narrow. And if you look last 60-year history, such narrow rallies actually don't end well.
Right. Understood. Great. Coming back, Neelkanth, to the US kind of economy and recession and so on and so forth, right? There's one report I read, it's from Bank of America, where they've looked at their own deposit base. And what they put out is that if you look at the median balance in the savings account or the checking account as they call it in the US, balances as late as April 23, which is 2-3 months back, were between 40 to 70% higher compared to just before the onset of the epidemic, of the corona pandemic, right? So which means if somebody had 100 rupees or $100, they now have at least 140, maybe 170. And the lower the income segment, the higher the balance. So in like, what recession? Like if people have 40% more money than they had 4 years back when the markets were booming and economy was looking quite good and so on and so forth. What explains this and where is this coming from and how do you see this panning out?
The savings had gone up significantly when the government threw out massive tolls. Right? So they gave a lot of money into the people, and those were saved. And those savings are now depleting. So we had done some arithmetic just last week, and the pace at which the savings are eroding, we will take another 5 months to come back to where the aggregate savings were before COVID.
Right.
And which is why I think so what has happened is that services consumption has come back to what we call the trend line. So if it was sort of growing at this pace, it had fallen. Now it is sort of coming back up to the trend line in the US.
You're talking of
the US savings, services consumption.
Services consumption before pandemic and after.
Yeah, so this was the pre-pandemic trend line.
Right.
It had dipped.
In the pandemic.
Then now it is close to that.
Right.
Goods, because when people are stuck at home, they don't consume services, they consume more goods. So goods had also seen this during the lockdowns, but then it flared up.
Right.
But it is still well above the trend line.
Right.
So people are consuming a lot more than they used to.
Right.
Which, as you can imagine, is not sustainable.
Right.
And that's the intention, to bring down demand by raising interest rates. So we think that the savings, which is the reason why you are seeing that the economy is not slowing down as rapidly. And remember that this is where the government's fiscal stance, the fact that the government is still effectively printing money and spending, right? So their tax collections are not going as fast as their spending is growing. And now you have seen Fitch cutting the US debt rating, and it's something we've been flagging for several months now, that the US debt to GDP, which is the measure of debt sustainability, is likely to keep going up for the next decade, right? And this is something that is in theory unsustainable, and something which is in theory unsustainable will at some point become in practice unsustainable as well. To add to that point on the monetary stance, see, in addition to raising interest rates, the developed market central banks are also reducing the quantity of money.
Correct.
Right, the amount of money in the economy. It's called quantitative tightening. Now, QT or quantitative tightening. So from the peak in the US, the money supply has actually come down by nearly $1.2 trillion. But when the Silicon Valley Bank failed, and the Fed allowed small banks to start tapping into their overnight reserves, the money supply has actually gone up. And you will notice that it is around that time that a lot of these rallies started to happen. That is around that time that a lot of the emerging markets started getting inflows as well. So what we have noticed in the last couple of weeks is that that has started to taper down again. Remember that the stance of the Fed is that they will continue to bring down the quantity of money for the foreseeable future. And so this interim measure where the banks had to be kept alive and therefore inadvertently, or rather they were forced to inject more money into the system, which is also showed up in a lot of the market rally that we've seen.
Great. So two follow-up questions, Neelkanth. First is, if you can just explain this quantitative easing and quantitative tightening, like what does it mean? What does it mean that there is more money in the system? If you can just explain a little bit for simple words.
So quantitative easing means that we just print money, right? That what any central bank does. It could be the Reserve Bank of India, it could be the Bank of England, it could be the ECB, it could be the Fed. They decide to. So if suppose the quantity of money in the US economy is say $15 trillion, and the Fed says that every month I'm going to buy $100 billion of bonds, and the Fed, like any central bank in the world, has the right to print money.
Right.
So they can create money out of thin air, and so as they buy those bonds and keep them on the balance sheets, it is quantitative easing. So basically, you're increasing the money supply.
Right. And so basically, the Fed is buying bonds and giving out money. And that money basically because the Fed is the entity that prints money, they just print and they give it. They don't need to have any income and so on and so forth.
Exactly.
And so the Fed's balance sheet, quote unquote, is growing.
Yeah. So on the Fed's asset side, they are holding those bonds.
Yep.
And the liabilities are the money
cash
that they have printed.
Absolutely.
And so this balance, the Fed's balance sheet keeps expanding.
Right.
So what happened during the COVID pandemic, as both fiscal and monetary easing had happened to protect the economy from damage, the Fed's balance sheet ballooned.
Yep.
Now, when inflation went out of control, they promised that they would do quantitative tightening.
Correct.
That they had perhaps printed too much money.
Right.
And they are now going to bring down by $85 billion a month. So that process is now about 1 year into. We are 1 year into that process. And that process, as it continues, you will see that the quantum of dollars available, and remember that the dollar-based cost of funding is what it affects not just the US,
yep.
but a lot of other countries as well. So many of the emerging markets, which are dependent, and they effectively have to track the rate cycles of the US dollar. So as the quantity of dollars available keeps shrinking, it's going to continue to cause problems for some of the emerging markets.
Right. And so again, on that point, Neelkanth, like one of the statistics I had heard was that during COVID, the Fed printed $9 trillion or something of that nature. That $9 trillion obviously is still making its way through the economy. They maybe pulled out $1 trillion. So in your sense, when does kind of this start,
to start to show up? So the failure of SVB was a sign of this.
Right.
It happened because of some of these reasons.
Right.
See, to add a layer of complexity to our current discussion, the money that we see in the economy is not just the money that the central bank prints.
Yep.
This is narrow money. What we see is broad money.
Right.
So we see M2 or M3, it's called M0. Right. What the Fed prints is called M0. This is M2 or M3. I mean, M3.
And what's the difference? What kind of?
Yeah. So sometimes, like in India, M3 is 5 times M0.
Right.
So then comes the basic question of, so how is this extra money coming from?
Yep.
Right. So if the RBI has injected 40 lakh crores, 40 trillion rupees, how are there 200 trillion rupees in the economy? And that's where banks like ours have a role to play.
Right.
So a bank can create money out of nothing. So if you are,
it sounds very dangerous by the way.
banks are, but banks that's the reason why central banking had to be created.
Right.
Right, because banks almost by definition, there's a lot of make believe that happens.
Right.
So if say today as a bank I give you a loan, that's just I give you a 100 rupee loan, and now there's 100 extra rupees in your deposit, and now as you start spending it, that money starts rotating, right? So when a bank gives out a loan, it is effectively creating money.
Right.
Now,
but presumably they have some deposits against which they are giving out the loan, right? Or
but that is the deposit.
Right.
The deposit that is there in your account is
so when you give a loan, right? So let's say you take $100 in deposit, right? On back of that you give a loan. So I take a deposit from Neelkanth, I'm bank, I give you a loan, right? So now there's $100 in his deposit, $100 in your deposit account. So now there's $200, right? So basically $100 of credit and $100 of deposit.
Yeah. Right. This, by the way, is the most counterintuitive thing that, when I started doing banking, I always thought like, you take deposit and you give a loan against it. Just to kind of get this into my head took me a long time.
That is how the P&L works, but that's now how money creation works, right? So now coming back to the first question about monetary tightening. So what happens is that as Ashish was saying, that as you invert the yield curve, so the yield curve is basically that, if you have an x-axis and y-axis, you have the interest rates. So this is the duration. So this is the 1 year interest rate, this is a 2 year, 3 year, 5 year, 10 year, whatever, right? Now, generally, if you are giving someone loan for a 10-year period, you would demand a higher interest rate.
Yes.
There is more uncertainty, right? So which is why it's an upward slope. This is the normal
yield curve.
Inverted yield curve means that for a shorter duration, as Ashish was explaining, interest rates are higher than they are for the longer duration. Now, when the yield curve is inverted, the banks are not incentivized to give out loans, and which is why the money multiplier starts to shrink as well.
Right.
So while the Fed may be taking out $85 billion a month, the reduction in the money supply M2 that the US economy sees is actually much faster than that.
Right.
Right. So so therefore, I think that when we are thinking about the impact on the economy, it's not going to be that all of that extra $8 trillion has to come out before the impact starts showing up.
Because the multiple is 8, then if they've taken out 1, then maybe already kind of 9 have...
No. So see, remember that the US economy has also grown in nominal terms.
Right,
absolutely. The US economy is, in real terms, among the only economies that is back to its pre-pandemic path.
Right.
So if this was the pre-pandemic path, it dipped, then it went up, and then it is now back, or actually it is now trending towards pre-pandemic path. Every other economy is well below. Even our economy, which is among the best performing economies, is actually well below the pre-pandemic.
Right.
In nominal terms, the US economy is above its pre-pandemic path.
Right.
So every economy needs a certain quantity of money for it to function.
Right.
For people to buy and sell stuff, companies to buy and sell stuff. So as the nominal GDP has also grown, so it will grow into the money supply. So you don't really need to take out all of that.
All of that, yeah.
Right. So you can see it as you printed it in bulk in 2020-21. Maybe it will take 3-4 years for the economy if you had not started sucking it out, and if you had not done monetary tightening, you didn't need to print for 3-4 years. But now that you are doing QT and banks are also trying to slow down their credit, maybe it will take 1.5 years, 2 years for the tightening to start showing up.
Right.
What also happens is something where, in order to complicate things a bit more, is risk appetite.
Right.
So, so people, if they are uncertain about the future, they will refuse to take loans.
Yeah.
Right. And so far, of course, everyone was afraid of recession. People have been postponing decisions, so that is there. Maybe for a 3 to 6 month period, that will reverse. People will say, oh, there is no recession. We are going to get into a soft landing in the US. So you can bring down inflation without causing a recession in the US. So let's start spending again. So which is why I think the period at which, or the time at which recession occurs is now consensus has pushed it out to the first half of the next year.
Of next year, yeah, absolutely. Yeah. Everybody seems to have kind of pushed out their consensus belief. Right. This, just going back to one of the points you mentioned, Neelkanth, which is the debt GDP ratio in the US and kind of how that, like every year there is this debt ceiling that they raise and there is a, huge political standoff against it and so on and so forth. Where does, you said it's not sustainable, but how does this end and where does this end and what does it mean for, of course, the US, but also like folks like us?
So, no, it's very hard to say where it ends. What is easier to explain is why it's happening.
Right.
See, from the political perspective, this ticks all the boxes for the current administration. In the
Right.
US. Right. So, if you notice what happened after the 2008-9 crisis, was that it took 7.5 years for employment to come back to the pre-crisis level. Here, we are already at record low levels of unemployment. So it has happened very fast. The second is that the wage growth in the bottom quartile is now higher than the wage growth in the top quartile. Meaning the bottom 25% of income earners, their salaries are growing faster than that of the richest people. Third, what had happened in 2008-9, after 2008-9, is that because you cut the interest rate so much, so financial wealth went up, right? Because equity prices went up, everything, real estate prices went up, everything. And so global wealth to GDP went from 3.7 to 4.9, so it worsened wealth inequality. Now, all of these are against the principles that the Democratic Party in the US stands for, right? So what they are seeing now is that unemployment ratios for, say, high schoolers are now comparable to the unemployment ratio for the overall economy. Earlier, they used to be much higher. So it is ticking all the boxes from a political perspective. So this will continue to happen till the time that the markets give up on it, right? And this is where, for the audience, maybe you can Google the new Triffin dilemma.
Right.
It's a long explanation, so I won't get into it here. But that the fact that so many foreigners, so many non-US corporations and individuals own the US Treasury as a safe asset. But if the US government's ability to back that up with tax collections in the future is, that belief starts to get shaken, then there will be a refusal by some of these entities, which is why the Fitch downgrade was, I mean, I don't think it's material in terms of changing it right now, here and now, but at some point it will become unsustainable.
Right. And so, Ashish, what like this, I think what Neelkanth is talking about is almost the reversal of the K-shaped recovery. The K is becoming a plus sign or whatever, right, or a T.
Sure.
What does that mean from a long-term perspective for equity markets?
So I think for the equity markets, there are certainly challenges in the US, right? So I think, as I mentioned, you have one sort of performance coming from these technology companies who are not going to just cater to the US demand, but the global demand for their products and services, right? But if you look at the consumption companies in the US, etc., they are not really seeing that kind of recovery. There have been, in fact, record number of bankruptcies in the US.
Right.
So while we are saying there has been huge influx of money and over the year, but this year the number of bankruptcies in the US has also gone up.
Wow. Okay.
Right. In fact, we had one very large bankruptcy in one of the largest truck operators in the US just last week.
Yeah, last week, yeah.
Right. So I think we have to differentiate between the various components of the US economy, right? So if you look at aggregate demand, it comes from the household sector, it comes from the corporate sector, and it comes from the government sector.
Right.
Right. If you, as you mentioned about household balances, yes, consumer demand has certainly been more resilient this year than what was expected. Some of the excess savings may be the cause of it. Some of the kind of boost post Silicon Valley Bank may have been the cause of it. But if you see US SMEs, I think they are still feeling the pinch of the regional bank crisis. So if you look at the credit conditions index in the US, that continues to tighten. If you see US SME sentiment index, that continues to week after week trend downwards. Neelkanth earlier mentioned about the fiscal stimulus. I think that also has been a big driver in the first half of this year, right? to just give you some numbers on that, this year first half US fiscal deficit was $1 trillion, right?
Wow.
So annualized is $2 trillion, which is double of last year.
Wow.
Right? And
100%.
100%. In as a proportion of GDP, that means there's excess 3% of GDP fiscal deficit this year.
Wow.
Right? So no wonder recession did not come this year. There were 3% of GDP fiscal boost that the economy got. Right? Going forward next year, even if let's say you go back to your 1 trillion, right? And we have to look at the delta, right? The marginal change, right? So if 2 trillion again becomes 1 trillion, it's not that they do away with the fiscal deficit.
They're just reducing the amount. Yeah.
Yes. So that will be a 3% of GDP headwind to next year compared to this year.
Wow.
Right. So I think there are certainly challenges. So even if the consumer demand is there, and the point on politics that Neelkanth touched about is also very relevant, right? Because next year is US elections, right? And at one hand, no incumbent wants to get into election with a recession, right? But the fact is that US government budget will come up for voting in October, right? So while the debt ceiling got raised, the money that the government needs to spend will be available to it only when the budget gets passed and it starts sometime in October. And there I'm sure there will be a lot of pushback from the Republicans because they don't want the fiscal boost to continue. So I think there is very interesting 6 months ahead of us, and I actually believe that its recession has not been averted but delayed.
Right, understood. Great. So shifting gears a little bit, in the global financial crisis, China was the growth driver for the world, right? And like, I guess almost for the last 15 years, they are the engine that has been driving the world, while the rest has recovered. Off late, particularly post-pandemic, they seem to have hit like a roadblock. So what's happening there? Is it a temporary phenomenon that, the tiger is crouching and waiting to jump, or are there structural issues and that, tiger has become old maybe?
You meant the dragon.
The dragon.
See, at this stage, I like to split growth into 3 parts.
Right.
So there is GDP growth or economic growth can come from labor input, capital input, and what we call total factor productivity. Right? So productivity growth.
Right.
And so to give you an example, if say I'm in my research team here, if I need to increase the quantum of research that we put out, I can add to my research team. So that's labor input.
Yep.
I can give them access to databases, faster computers, a lot of AI algorithms or whatever. That is, I'm putting money to work, so that is capital input.
Right.
Getting them to work smarter with the labor and the capital that they have is productivity. If you measure the Chinese economy on these fronts, the labor input is going to be negative because their demographic decline is actually quite accelerated. It is much faster than had been expected even 5 years back.
Right.
So the number of births is collapsing. The number of people of working age shrinking very rapidly. Total factor productivity was actually negative even before the pandemic.
Wow.
And this takes us back to...
And that's quite like you would assume that China, because of so much technological advancement that has happened, the productivity would have been growing. But you are saying actually it was not, even before.
Correct. So you can increase labor productivity by injecting a lot more of capital.
Right.
But if you look at the combined productivity of capital and labor, then that number was negative. And I'll explain to you what that means.
Right.
See, in any government, and this is a framework that we'll find useful even when we think about India. In any society, there are basically 2 power centers now. 200, 300 years back, there was also religion, but today there's just business and there's politics.
Right.
The state, which is the government, and there is business. How the power balance between the 2 works is very important for the economic growth and the structure of the economy. Now, in any communist country, the primary driver of policy is what they call the principal contradiction. Basically, that this is the main problem in the economy, which the government has to solve. When Deng Xiaoping started to reform China in the late 70s, and then it was institutionalized in the constitution in 1982, saying that the principal contradiction is that the people desire to be rich, but the current structure cannot make them rich, so we have to change. And that is when the state willingly took a back seat and allowed business to flourish. After 2012-13, I think there was a severe debate within the Communist Party, along with the change of leadership. And it so happened that they realized that the business was becoming too powerful, and that the state had to increase its power again. Which is why you would have seen that the SOEs, the state-owned enterprises, the government, the PSUs of China, they started gaining share back again. Now,
and also you had all the Jack Ma and events of that nature.
That started happening in 2018-19 as well, where the state really felt threatened that these are really rich people running large businesses, and they are openly challenging the state. Now, when you transition like that, right? So you transition, and even look at the real estate problems, the current real estate problems. The way the state is addressing them is by getting the state-owned enterprises to buy out those assets, right? So that prevents failure. But remember that in state hands, in government hands, the productivity of capital and labor is generally lower. So TFP, or total productivity in China, 2014 to 19, was falling at 1.5% a year.
Right, and your contention is that was happening because the production was moving from private hands to state hands, and state hands
was a major driver of that.
Understood.
And the second is that so the growth was completely coming from capital injection.
Right.
So real estate construction, infrastructure construction, a lot of automation, robotization, so lots of, and complete domination. Now you're seeing the same thing happen in the battery ecosystem, what earlier happened in wind and solar. So now what is happening is that, and remember that nearly a third of China's goods exports are by multinationals operating in China.
Right.
They're not by Chinese companies.
Right.
And of course, 20 years back, it was 60-70%. Now, if you look for the next 5 years, so the demographic decline continues. The stance of the government is not changing. So basically, the TFP growth will be at best the same, or zero or negative. And capital formation needs to slow down because real estate investments are slowing down. The local government financing vehicles are no longer active. They cannot leverage themselves more. And so they are going through a severe growth concern. Now, the only solution to this is, and remember that, when demographic decline happens, meaning that your dependency ratios are starting to go up, if there is no state support, so suppose someone is like 50 years old or 55 years old, and there is not enough pension assets. So if you plot pension assets as a percentage of GDP, China is actually somewhat lower than India.
Wow.
Now, if you are at that stage, so then as people get closer to retirement, they're actually trying to save more. They're not confident enough because of the severe demographic shift. So the only way to counter this is for the government to trigger consumption growth.
Right.
Which means that you have to hand over cash to people.
Right.
In some form or other.
Yeah.
There are more stable ways of doing it, like providing better health insurance, providing better pension assets so that they feel secure. But that's a slow and steady type of. If you give a cash injection, you cause inflation. And which they are again, because it's destabilizing for any economy, which they don't want to do. So this expectation that people have, or markets have had, that China, whenever it gets into trouble, it's going to re-stimulate, is something that I've always been uncomfortable with. Not always, meaning the last couple of years or so, I've been very uncomfortable that it's not going to happen. And that's unfortunately playing out. So this is negative for many other places other than China. Remember that China is now very large, right? So total goods demand in China is 2/3 as large as the US goods demand.
Wow.
On a per capita basis, of course, it's lower, but the Chinese population is 4 times larger than that of the US. And so if Chinese goods demand slows down, it creates problems for many people. And that, when we discuss Europe, I guess, It'll become important. Europe was China was a very important destination.
Absolutely.
It was very important for Japan. And so these economies then start to struggle. Commodity suppliers, like in many emerging markets, which are not linked to new energy solutions, will start to struggle because a lot of their growth was happening because of demand from China. So yeah, I don't expect Chinese demand to really pick up anytime soon.
Great, thanks. I think Neelkanth will do a special session just on China because it's a fairly complicated and large topic. So Ashish, you're talking about this balance sheet problem in China. If you can explain just what that means.
So on the balance sheet, we have two sets of balance sheet. One is the bank balance sheet and the corporate balance sheet.
Right.
If the corporate balance sheet carries too much leverage, there's a question about whether the corporate will sustain or will be able to fully service its debt or not. And these loans that the corporates have taken come on the asset side of the bank's balance sheet. These are the loans they have given up. So the market believes that these assets that the banks carry are not going to be fully realizable in their value. And that is why...
Because the corporate will not pay.
And that is why the equity value of the bank is being put at a fraction of its stated book value.
And you said it's about quarter of...
So currently, price to book on average for Chinese banks is 0.25.
Wow, which means if they've raised 100 rupees of equity, the market is now valuing them at 25 rupees.
Yes, so the amount of equity they have raised and accumulated profits, which is the book value, and currently the market value is 1/4 of that.
Wow. Understood.
So I think that is why markets don't necessarily believe that Chinese market is very cheap and they are very gung-ho about the China given the growth outlook. The other thing that we are starting to see because of geopolitical reasons, there is certain level of discomfort certain international investors are starting to have towards China. And particularly American funds are questioning or are being nudged to look at what is their capital outlay in China. And we are seeing not only incremental capital outlay coming down, but some fund actually pulling out capital from China as well.
We saw Sequoia as an example.
Yes, So I think people are very uncertain about those geopolitics as well. And that will have huge implication for other markets because China had been a big recipient of global capital flows. Of course, it's been much larger than most other emerging markets, but also because there were a lot of capital investment happening, the influx of capital was also very large.
Sounds like a great conversation. Thank you, Neelkanth, and thank you, Ashish. It was a fantastic conversation. I hope you enjoyed as much as I enjoyed learning from you. Thank you very much.
Thank you.